Hello, everybody. A very good afternoon to each and everyone present over here for this very important webinar on Standards on Auditing 240 on frauds. We have today as faculty a very good friend of mine, Mr. Jomon George, who is a great auditor himself and knows the subject in and out. So I'm sure all of you will be benefited by this webinar on auditors' responsibilities relating to fraud in an audit of financial statement. With these words, ladies and gentlemen, I once again welcome all of you. I'm sure that you will all be benefited by this webinar. Thank you all. Over to the organizers.
Good afternoon, everyone. So on the behalf of Auditing and Assurance Standard Board of I welcome all the participants who have joined today's session on auditor responsibility relating to fraud in an audit of financial statements. It is my privilege to also welcome our esteemed speaker, CA Jomon K. George. CA Jomon K. George, a fellow chartered accountant with over 33 years of practicing experience. He is a founder and managing partner of JVR and Associates. He served as a chairman of Southern India Regional Council of ICAI and was also served as a chairman of Ernakulam branch of ICAI. He has delivered more than 1,000 presentations on accounting and auditing aspects. He is also a peer review trainer. Apart from the profession, he has played key roles in the community, like served as a president of Rotary Cochin Central, secretary of Kerala Management Association, and treasurer of Regional Sports Center Kochi. He also served on the advisory board of St. Teresa College, Ernakulam, and he is also the author of the book Trails, that is a reflection on his personal and professional journey. So now I request CA Jomon Kejo sir to start this session, and over to you, sir.
Thank you. Good afternoon to all of you. My very dear friend and Vice Chairman of ASB, CCM, C. Ravi Patwa. In absentia, Chairperson of ASB, another dear friend, Sri Priya. The team from ASB, Vivek, and probably Mega Saxena would join soon. Respected senior members joined us online, my dear fellow colleagues. I'm extremely delighted to be here with you online though, to discuss, as Deviji said, a very important topic of Standards on Auditing 240. I was fortunate to be a member of the Auditing and Assurance Standards Board way back in 2005, 20 years back. And I've seen and experienced, and to some extent, I feel contributed to the cause of bringing out useful literature for the membership at large in dealing with audit situations, assurance situations, statements, guidance notes, all those things. A lot of involved, intelligent work goes into the work of ASB. And I'm extremely happy that both Sri Priya and CCM Ravi are very, very actively engaged in the activities of ASB this year. So thanking both of them and ASB for having me here. Let me move on to the specifics of the topic. Instead of going directly into the SA 240, I thought of having a brief introduction of the standards on auditing, the spirit with which we have to approach and deal with and apply at the work desk. That's very important. Apply at the work desk. The standards on auditing, interchangeably the term used is auditing standards also. And with that, let me now try to share my PPT slide. Is it visible, Vivek? You have to unmute. Is it
yes,
okay?
Sir, it is visible, sir.
Yeah, let's have a quick intro onto standards on auditing. The evolution, if you look at the history and evolution of standards on auditing, as many of us would know that the APC was set up in 1982. It was at that point of time known as the Auditing Practices Committee, and it's issuing standards on auditing practices. In 2002, the board was renamed, the committee was renamed as Auditing and Assurance Standards Board, in alignment with the International Auditing and Assurance Standards Board of the IFAC. And it started issuing AAS, Auditing and Assurance Standards. 2008 underwent a major change. A new preface was issued to auditing standards and related documents. And in the result, the new classification today we have is that of SQCs. SQCs, Standard on Quality Control, we have SQC1. And other standards are broadly classified into engagement standards, further divided into standards on auditing, standards on review engagements, standards on assurance engagements, standards on related services. Related services, for example, SRS 4410, they are all nil assurance engagements. There's no impression of an audit. We should not give any impression of an audit to the users of the financial statements, compilation of financial statements of non-corporate entities, etc. And SRS 4410 is one of those examples, and they are nil assurance engagements. So they cannot come under standards on auditing or review engagements or assurance engagements. So that's a residual classification of standards on related services. Now, why comply with standards on auditing? While all of us are here today discussing this, why the big question? Why do we really need to comply with standards on auditing? My version of looking at it is that the expedite audits effectively in accordance with generally accepted auditing practices, utilize resources effectively, the time factor, the team which we have, the students, article students, and all those resources have to be very effectively utilized. Because auditing is an organized activity, is not without economic consideration. So best use of resources are quite essential. Therefore, auditing standards or essays help us in doing that. To guide, direct, and supervise our assistants properly, to ensure quality control in an audit. We really need to have a lot of quality control in it. As you know, the profession, the membership, and overall the profession and the membership are under the lens than ever before. There are there's a lot of surveillance, stricter oversight over the profession, stringent oversight of the profession. So one has to be extremely careful in ensuring quality control, so that we can complying with standards. We can disprove any charges of negligence. It could be a shareholder complaint. It could be a management dispute where the auditor is dragged into some kind of a disciplinary action. If the audit is done properly in compliance with standards on auditing, then the chances of you getting finally charged or the chance of getting acquitted is substantially better. And therefore, that's it. And today, as you know, peer review has been extended. The scope of peer review has been extended. And even very small firms with the 3 partners or those who are doing bank audit, any bank branch audit, will also fall into the purview of the peer review. Peer review dates have been slightly relaxed and extended, but all of us are sooner or later going to be coming under peer review. One of the important considerations in peer review is ensuring quality control, and compliance with technical standards is a key aspect, one of the key aspects of doing the peer review. Therefore, to face and pass peer review, the standard, if you look at the statement on peer review, it says that a peer review certificate is a hallmark of professional excellence. Hallmark of professional excellence. So I have it I'm sitting in my office now. We have displayed it in the reception area of our office. Little bit of branding we have done. And we also sent a mail when we got second round of peer review, we got the certificate. And therefore, it's very important that we keep up the standards and comply with the standards. More than anything else, look at this. The Companies Act 2013, we still say it's a new act. 12 years into existence. The Companies Act 2013, when it was enacted, in section 143, it's a very important section. I'll come to that. But then look at this line. Every auditor shall comply with auditing standards. It's a single line, but it's a very, very challenging, very demanding line, putting a lot of onerous responsibility on the auditors to comply with standards on auditing. Till 2013, what was the scenario? From 1982, as we have seen, APC or ASB, as it was in the respective times, has been formulating standards and informing the membership that these standards are mandatory standards. So do comply with the standards. If there are non-compliances, there are issues. The institute, through its disciplinary mechanism, could take action against erring members. But here is where it's now become part of the statute book, 12 years. Many of us are still not aware. Last week, I was addressing a group of members in a small branch in Kerala. where very clearly said that this is shock for many of them. They are really not been informed about, rather aware of this very, very demanding mandatory provision under the Companies Act Section 143. 143 is a very, very important section. I said it falls in Chapter 10 of the Companies Act 2013. Chapter 10 deals with audit and auditors. Section 139 from appointment, going up to 148 dealing with cost audit. Equally important for chartered accountants and corporate accountants. Corporate accountants is a chapter 9. It's a preceding chapter which is on accounts of companies. Section 128 to 138. Though we call it accounts of companies, it's a mix of things. You have 128 books of accounts, 129 financial statements. But then NAFRA as 132 is falling in accounts of companies. NAFRA is set up under 132 of the Companies Act 2013. 3 sections down, you have 135 CSR. Though it is not strictly on accounts-related matters, but CSR is also falling in Chapter 10. Then moving on to 138, which is on internal audit. They're all coming under this chapter of Chapter 9 or 128 to 138. Now, the Chapter 10, 139 to 148. In the most important or most demanding, most relevant section for practicing chartered accountants, most of us are here practicing chartered accountants, I presume, that it is mostly for the most important because it is powers and duties of auditors and auditing standards. So we're going to discuss auditing standard 240 now. So this introduction I thought would be relevant, and that's for understand that Companies Act 2013 has made standards on auditing part of the very, very integral part of the statute book in the most important section 143 through subsection 9. And applicability when we discuss particularly traveling across the southern region. I was fortunate to be the chairman of the region in 1920. And when you go and address members on these standards, in smaller places, there's a tendency to say that the standards on auditing is for large corporates. It could be for a Reliance or Infosys or a whatever. But then let us please have a look at this slide and where the expression of opinion, wherever there is expression of opinion, standards on auditing would apply. All the standards on auditing are mandatory. There are no partial or complete relaxation like we have accounting standards for small and medium companies. So the auditee, in the case of an auditee, if there is expression of opinion, that is where the auditor says, gives a true and fair view, then it is very, very important to note that standards on auditing will squarely apply with equal force in a small corporate, non-corporate tax audit. In the audit of the branch of a bank, standards on auditing will have equal force and applicability like we have in that of a large corporate, like we talk about, or Infosys or a TCS or any of those companies. So it is not just for corporate audits, but corporate audits, it is mandatory under the law as well, under the Companies Act, as we have seen, 143(9). This is very, very important. Vivek, is the going okay? Audible, clear enough?
Yes, sir. Yes, sir. It is nice, sir.
Okay, right, okay. So we have, and in case if it's not important that I continue to speak, if members who are there to be unmuted and if there could be questions in between, that's also fine with me. Is that the normal practice?
Yes, sir. After completing of the session, we will take questions from the members, sir.
Oh, Q&A is only towards it. In between, normal it is not there. I understand.
Yes, sir.
Okay.
Yes.
Yeah. So if we need a response from the members, like on whether we are audible, clear, or something like that, how do you do?
Yes, sir. We have received a message from the members that they are not receiving any audio or video. Then we have the technical support team also.
Technical support is already okay. Good.
Yes, sir.
Good. Okay. So this is, please note that standards on auditing have this kind of an applicability. And before we go into the specifics, let me also, since this is a close group of chartered accountants, this is a shameful remark made by a former MCA secretary, which is making rounds in the editorials of many of the business dailies. He said, we do not, we mean the regulator, the MCA, or now that spirit is also being echoed into the PMO and all that. So we do not expect the auditors to find a needle in the haystack, but then they must see the elephant in the room. Smaller things like a small needle in a haystack. I know people who have been in the villages would know the haystack is where the hay, the hay is stored on a pillar, on a pillar or a tree to feed the cows and all that. So there, the haystack to find a needle is so very difficult, but auditors must see the elephant in the room. There's a strong message. That's a strong message. That's why it's a shameful remark as far as the profession is concerned, that we have to be extremely vigilant, careful to audit situations. And it is in that context that we have been conducting a lot of programs. I had the privilege of addressing in Hyderabad a couple of weeks back the CNDG officers, where they have been, we were empowering. This is a residential program, empowering them on the various standards in auditing and audit approach and all that. So it is a wonderfully organized program. Could be part of that, and so therefore these are the things which one should keep in mind as we approach, deal with, and apply standards in auditing. With this introduction, let me move on to Essay 240, the auditor's responsibilities relating to fraud in an audit of financial statements. The schema is like this. We'll have an introduction of the concepts. Then we have a detailed main session. And as Vivek said, we can have a Q&A also towards the end of the session. Hopefully, ASB secretary would also join in by that time.
Yes.
What is fraud and fraud risk factors? Characteristics of fraud is a fraud triangle. Responsibility of the management and those charged with governance. That's a term sometimes interchangeably used with management, but strictly has a different meaning. We'll come to that a little later. The responsibility of the auditor with regard to fraud. The key question is that an audit has been done and subsequently a fraud has been detected. Can the auditor be taken to task? It's a very, very relative question. It has to be answered in the light of the learnings of the next probably one and a half hours. And then by the end of the session, we would be clear that we cannot be held responsible for all the frauds, because if they're so deeply laid down, ingenuously laid down frauds which could not be detected in an audit, because again, we have the huge issue of the expectation, societal expectation gap of saying that an audit is seen as a seal and a guarantee for total accuracy and total lack of misstatements. Because audit, we give only reasonable assurance. The institute has been trying to educate the public through industry associations and organizations, but still the layman who reads that when there's a corporate failure, it is only the auditor who is blamed. This is very unfortunate. So therefore, the responsibility of the auditor has to be professionally understood by the professionals first, and then that has to be percolated down into the users of financial statements and the general public at large. Professional skepticism is something which needs to be discussed at length. We have a separate slide on that. I'll come to that. Risk assessment procedures and related activities, the auditor, what he has to do. Identification and assessment of risk of material misstatements. Responses to assess risk of material misstatement due to fraud. How will the auditor respond? Evaluation of audit evidence which has been collected. Additional evidence sometimes may have to be collected. That has to be seen. And there could be situations where the auditor, because of the complexities and the irregularities involved, the auditor doesn't want to continue with the engagement. Then what are the things he should do? And the huge importance of management representations, separately highlighted through a separate, we have an extra slide on that. But while at management representations, let me also tell you about SA 580. SA 500 deals with evidence. 501 is additional special considerations. 505 external confirmations. 510 opening balances. So on the story goes. 550 related parties. 570 going concern. 580 is written representations by the management, which commonly occurs wherever I have discussed with members across the country. It's also interchangeably used, or rather the term used is MRL, management representation letter. So it's so very important that the management acknowledges their responsibility in the preparation of financial statements, in having effective internal controls, in taking steps to prevent, if not prevent, at least mitigate the possibilities of fraud and error and so on. Therefore, that's very, very important that we obtain management representations. Last year, when the audit trail was made mandatory, we made some customization or changes to the letter of representation and made them talk about the audit trail. Where there's an audit trail with the required proof, where there's no audit trail, they have been made to say that the software does not have the feature of audit trail. And this year, the only change in company audit this year, if you ask me, is regarding the additional clause in audit trail saying that it has been retained, because since last year was the first year of audit trail applicability, wouldn't say that. This being the second year, the audit trail is being retained as per the requirements of law as a new clause. So that's important to management representations and communicating to management and those charged with governance. Your findings are to be communicated. If there's a fraud, particularly, the communication should be quite loud and vocal, and therefore that has to be done. And you also attention is invited to SA 260, which talks about communicating audit findings with those charged with governance. Now, subtle difference of management. Normally, when you say that in a corporate environment, we say that management would mean the board of directors, of course, the subcommittees and all that. But then those charged with governance is a slightly wider connotation. If there is a remote project and there's a project manager who is in charge of the entire project, and let's say that 30-40% of the revenue of the entity is coming from that particular project or that location, where some manufacturing happens and dispatch either comes to the head office or dispatch is made to customers or services are rendered to remote locations from there. And all that situation, the person in charge of that location will also come under the definition of TCWG. I was just trying to give a very simple example. And lastly, if need be, communicating to the regulatory and enforcement authorities. The new ethical code of the institute, we have something called the NOCLAR. NOCLAR is mostly now, as of now, it's in the listed space. NOCLAR is non-compliant with laws and regulations. The spirit of NOCLAR is that if the magnitude, the intensity, or the amounts involved, the people involved, the impact of a particular irregularity or a fraud is, or non-compliance rather, it may not be fraud, can be non-compliance also. If the non-compliance is so far-reaching, so that to an extent where it would jeopardize the public interest, then the spirit of NOCLAR is that the auditor should blow the whistle louder. Not just for the shareholders to hear, louder enough for the regulators to hear. If the client is a company in the listed space, SEBI may have to be alerted. SEBI may have to be informed by the auditor. Normally that doesn't happen. This is where the impact is huge. Similarly, if you are in the banking or non-banking space, then RBI have to be informed. That is the spirit of NOCLAR. So same here. Here also, if there is a huge irregularity and fraud detected, then the auditor should consider communicating that with the regulatory and enforcement authorities. Now come to this very, very important point of professional skepticism. Requires ongoing questioning of whether information and audit evidence suggests possibility of material and misstatement due to fraud. Look at the left-hand side. So let us not take the client's integrity and honesty for granted. I would say do not take people, documents, explanations for granted. There should be a questioning mind. You should raise your eyebrows wherever required, and that is where skepticism comes into play. This is professional skepticism should be, and it is to an extent, it is part of our DNA, every practicing chartered accountant. When he approaches an audit situation or attestation service when he renders, this is a very important part of the work culture. But this is often has taken over a period of time, got diluted, and we tend to take things for granted. Documents for granted. Inventories, for example. Why is that CARO 2020 contains so many clauses on inventories? And people say that CARO 2020 is drafted from a banker's perspective. To an extent, yes, and not without reason. It's not without reason. So non-existent inventories sitting in the balance sheet of constituents. So many of the banks have that. Receivables may not be receivable at all. Provisions and all those things have not been made. Therefore, we are not being critical enough. And we all been conventionally trained by seniors would agree. I've also put in 33 years of my practice. And seniors would agree that we have been trained to approach, not to approach a situation with the preconceived notion that everything is wrong. Now, the mantra and the thinking is changing now. We are now approaching a situation not with the preconceived notion that everything is right as well. There are fraudsters, there could be self-interest, there could be concealments, So one has to be aware and awake to that situation and that kind of possibilities. And that is what professional skepticism all about. Our dear friend, Mr. Mohan R. Levy, who writes regularly in the business line, wrote an article after the ILFS issue and all that, where he said the auditors have been clinging on, the audit profession has been clinging on to the decision in Kingston Cotton Mills case, delivered in the 1800s, where the judge said that the auditor is only a watchdog, not a bloodhound. Gone are those days. In a discussion in Delhi, I think it was in Delhi that Amadi Chopraji, former president of our institute, and when I was member of the ASB, Chopra sir was the chairman, and I had a great pleasure of learning under him. We share a very, very healthy friendship. I can use that freedom of that term. Patronizes me a lot and sends all the Deepavali and holy wishes and remembers very thoughtfully connected, and a great learning experience I had in it. Chopraji in lighter vein was saying that what are we talking about, Are Baba? You're talking about watchdog, bloodhound. Anyway, we are dogs, at least bark here. This is a message he wanted to say. I think that says everything. So documents may be accepted as genuine if no contrary indications. However, when in doubt, the auditor may. So doubt has to be doubting or a little bit questioning is not a vice. It is an essential virtue. This puts us in good stead, particularly if some irregularity is detected or goes undetected by the auditor and comes up later, surfaces a little later. Confirmations directly from the third party, something which is recommended. Engage an expert to assess the authenticity of major important transactions, which may go outside the organization also. Investigate if response to inquiries is inconsistent. In collection of evidence, in evaluation of evidence, as auditors, we are always required to corroborate evidences received from various sources, internal audit with external evidence, or evidences received from various different sources on a particular issue which is under debate, or probably, as we can say, as SS 701 says, a key audit matter which has to be discussed, understood, and either resolved, or if it's not resolved, it will end up in an audit qualification, adverse opinion, audit qualification, or in a lighter form, maybe in an emphasis of matter paragraph, like in SS 706. So this is what very, very, very important. In dealing with audit situations, the auditor has a responsibility to make sure that, or reasonable assurance to make sure that financial statements are not having any material misstatement caused due to fraud or error. Therefore, fraud possibilities we are not ruling out. We are becoming increasingly skeptical, exercising more skepticism. While on that, if you have read the NFRA report on the irregularities of IL and FS, it's a 305-page report. 305-page report. The crux of that, if you ask me, the crux of that is that the multinational firm which was engaged in this did not exercise professional skepticism to the extent required. The second point, the crux is that I've been teaching for 20 long years at the institute's branch here in Cochin or Ernakulam. Those who come to Kerala would know. And then there, in the first class, we used to teach this, or rather, this is a lesson which then becomes part of our work culture, is that the auditor should collect sufficient, appropriate evidence to form his opinion on the financial statements, to base his opinion on the financial statement, to make assertions which would finally form the opinion on the financial statements, either a clean opinion or a qualified opinion, adverse opinion, and in extreme situations where the auditor is not able to collect sufficient appropriate evidence, he would go for a disclaimer as well. So in this particular case of close to $1 trillion irregularities to $1 trillion rupees, or 92,000 crores to be precise, to be considered precise, in the range of 92,000 crores. Lack of professional skepticism and failure to collect sufficient appropriate evidence led to these irregularities. So that's a huge, cast a shadow on the reputation of the profession, the corporate culture of the country. So we have so many cases, Byju's, which has come from Kerala. Now the latest is IndusInd Bank. Things are being investigated. But at some point of time, we are forced to accept. We're forced to accept. Unfortunately, forced to accept that there has been lapses in the audit procedures, which has resulted in this kind of issues. Risk assessment procedures and related activities. The auditor should perform risk assessment procedures to identify the risk of material misstatement due to fraud. That's a blanket statement. The areas covered should include management and others within the entity. The fraud, which are the fraud, where is that? Which is soils fertile for fraud or situations conducive for audit, for fraud. It's I would say that an inactive or rather management was not involved, remote locations, not having qualified, experienced people, lack of internal controls, SOPs for reporting, MIS, periodical reporting formats, system to ensure the compliance with the applicable laws and regulations. It could be filing a GST return. It could be filing a TDS return. It could be the returns which we file with the registrar of companies, the MCA. So all those things would, these kind of loose environments would be conducive for fraud. And that is where when the hundi is open, there's a saying, when the hundi is open, the saint himself or the priest himself is prompted or come and steal out of that, because it's an environment which is so tempting. Therefore, that can happen. So that is one thing about that. Those charged with governance, we have seen going beyond just the core management and people who are in charge of the governance of the company. Unusual, unexpected relationships. These are all these things we are going to expound in the slides that are to follow. Other relevant information which we have to collect, because it's always corroborative. A question leads to an answer to a question leads to another intelligent question and so on. And finally, evaluate the fraud risk factors. Where does a fraud really exist, or it is only a doubt? So you have to either confirm your doubt or dispel that there is no fraud. Inquiries of the management. Assessment of risk of material misstatement due to fraud, including nature, extent, and frequency of assessment. What is that the management is doing to ensure that the possibilities of frauds are mitigated? The auditors should do that. In all these things that we do, there should be a proper documentation. No, the new mantra is there's a separate standard. In fact, in Hyderabad, we discussed as 230 as well, that is audit documentation. The entire work that you do, the entire explanations given by the management responses. And not like the olden days. Today, when we talk about documentation, we are not talking about a thick box file like this. Digital documentation is fine. Visuals are fine. All those things are fine. Photographs, videos are all part of today audit documentation. So that is what one should look at. What is it the management is doing to reduce or evaluate the possibility of unplugging that also. One is that if there's a possibility of fraud, if a person of poor integrity has been identified in the team, the core team, management may get rid of him or put him in a less important job or move him out of the core team. Those are things which management should do. Proper use of technology, essentially. Of course, technology risks are another huge issue, but then use of technology with lesser human intervention. And even I would say that, it may sound old-fashioned, even having CCTVs in manufacturing places, dispatch locations, remote locations, all that's really required. It has created, pilferage and all that has been substantially contained by using all those things. Process for identifying and responding to fraud risk, including specific risks identified. That is what the management is doing. And communicating all this with those charged with governance on the above issues, we have to communicate. And communicating to employees regarding its views on business practices and ethical behavior. There could be training programs. There could be training programs not only on the processes, but on having an ethical culture in the organization. So the auditor should evaluate all this. Management and others within the entity. If the management, the auditor has to exactly look whether they have any knowledge about actual suspected or alleged fraud affecting the entity or the activities of the entity. Internal auditors. Internal auditors, always we say that internal audit is an audit for the management. The frequency, it could be monthly, it could be quarterly, and they are closely working with the management to ensure that the processes, the SOPs, like for example, we have a vertical called system study. We call it the corporate doctor. And most of the places, corporates where we've done a corporate doctor, he comes out with an SOP or a manual for procedures. And then the management would ask us, how do we ensure that these are properly followed? So you have to have internal team, internal muscles, rather internal systems to do that. But at the same time, if you wish, we can handhold you through a process of 3 months or 6 months. Sometimes that gets converted into internal audit. We will ensure that these kind of good processes, governance practices are existing and in place so that the possibility of frauds, irregularities are reduced. So internal audit is essentially important an activity. And today, for larger companies, it is mandatory under Section 138 of the Companies Act, though many of the corporates are not aware about it. And in CARO reporting, the external auditor, the statutory auditor, is required to report whether there is an internal audit system commensurate with the size of the company and the nature of its business. And also specifically from CARO 2020, it was not there earlier. CARO 2020 says whether the reports of the internal audit has been seen and verified by the statutory auditor. So making a blanket statement that is something commensurate is not enough. There should be a report of the internal auditor, and not only that, the statutory auditor should get sight of that and then make use of that. That is another, I think it's SA 610, which talks about using the work of another auditor. So all those things have to be kept in mind, and that is how the auditor should try to gather information about the possibility of internal audit reports. Like, for example, when we go for a bank audit, we are asked to, we always verify the concurrent auditor's report, the RBI inspector's report. So we may not tread over all that again and again, but then if there are indications, then we'll not probably stop there. We'll go with the deeper drills into the susceptible or rather suspected areas of fraud. Understand how those start with governance, exercise oversight of the management, the process of identifying and responding to fraud risk, internal controls for mitigating, as we've already discussed, mitigating those risks. Those start with governance about the knowledge of actual suspected alleged fraud risk management, and those start with governance. Unusual, unexpected relationships, other information, and evaluation of audit risk factors. Evaluate whether there are unusual or unexpected relationships identified in performing analytical procedures. Not only analytical procedures, substantive procedures also. You may know that the audit procedures are broadly classified into compliance procedures and substantive procedures. Analytical procedure is falling under the broad definition of substantive procedures. Compliance procedures are primarily tests of control, tests of internal controls. So the auditor should initially do a preliminary round of compliance procedures. Based on that, he derives some comfort or sometimes discomfort on the quality of internal controls, the quality of people, the quality of reports that they are producing, the quality of periodical financial statements, and finally the financial statements, if they are prepared by the management. But my experience in the last 33 years tells me that, strictly speaking, though the auditors actually prohibited from preparing financial statements, mid-sized corporates, and in my experience, even some of the listed entities, the corporate accountants do not have the wherewithal, willingness, readiness, and the required domain knowledge to prepare sensible financial statements in compliance with the Schedule 3 requirement, in compliance with accounting standards in the smaller sphere of things, and 250 crores and above 250 crores and net worth and listed companies in days. So therefore, the auditor, and sometimes it felt that some part of the time which should have been dedicated to audit considerations are lost or sunk in preparation of financial statement. And we assistants sometimes have to be put on that job. So that's something which one has to take note of. So here is where unexpected relationships identified in performing substantive procedures indicate the risk of material misstatements due to fraud. Other information obtained indicates risk of material misstatement due to fraud. And the auditor should evaluate if information from the risk assessment procedures indicate presence of fraud and risk factors. For example, there's huge variations in inventories, people leaving frequently, the no reports, remote locations, where the management attention is not enough. Bank accounts are not reconciled. the so-called closed bank accounts, there are no confirmations available. Debtors and creditors, there are dispatches towards the end of the year. Dispatches towards the end of the year not supported by e-way bills and delivery challenge. So somebody is trying to meet a target and all these things come back. And unrealistic profit is being moved, so on and so forth. There are a lot of issues. One has to be aware and awake and alert and vigilant to fraud situations. That is what the evaluation would lead us to. Identification assessment of risk of material misstatement. There's a little bit of, because it's a very, very lengthy standard. So in the literature which we have developed, there are some bit of repetition, but I will go through that in a way that it is well understood. Presume fraud risk in revenue recognition. This is what exactly I was trying, just a minute back I was trying to say this. Evaluate types of revenues, transactions, assertions leading to this. Document if presumption is not applicable. Now, we live in we had work in progress, and if you go to the tech world, IT companies, there's something called the unbilled revenue. It could be played around with. It can be played around with. So unbilled revenue, what is the work done? Whether there's a proper matching of expenditure, unbilled revenue. I'm just telling you an example. Similarly, in a case where, tillers were manufactured, manufacturing tiller, hand tillers manufacturing company, the dispatches towards the year end. In fact, the sales of March formed 80% of the sales of the company, which finally resulted, to cut the long story short, as the auditor finally we were forced to issue an adverse report, not a qualified report, adverse report, because when we started saying, how do we qualify a report these days? SS 705 tells us modifications in the auditor's report. It is not subject to, it is except for the matters specified in basis for qualified opinion paragraph, the financial statements give a true and fair view. That's how we do a qualification. So except for, we started saying 1, 2, 3, doesn't stop there. 4, 5, 6, finally went up to 12 key points. At that point of time, we said this cannot be a qualified report. This has to be an adverse report. That is, technically speaking, you look at the standard, it says when it becomes so material and pervasive, the auditor will have to convert, or rather an intended qualified report into an adverse report. So that is incident to saying this. So the revenues, suppression of revenues as well as artificial showing of revenues can happen. That's a possibility of fraud. Treat those assessed risk of material misstatements due to fraud as significant risk. Naturally, yes, they are significant. If significance is nothing but material, materiality and significance is interchangeably used. If you look at accounting standard 1, it says that all significant accounting policies are to be disclosed. So significance and materiality is kind of understood in a common context, or rather with the common spirit. Obtain further understanding of related internal controls. Now, when we suspect the fraud, or in layman's term, if you say, when you smell the rat, you have to essentially do deep dives, evaluate internal controls substantially with deeper. That is, we go back to, after doing the first round of compliance procedures, we did some substantive procedures like revenue analysis, ledger scrutiny, trial balance checking, all those things, some kind of verification of assets and liabilities. Vouching, which may sound old-fashioned, but I still feel that verification of source documents, at least on a test basis, is quite essential and important from an audit perspective. It should be an integral part of the audit process. That's what my experience tells me. And we do that still with a lot of involvement in putting the students with a clear direction. An audit program again is emanating out of, it's a 300 audit planning, which talks about an overall audit strategy and a detailed audit plan. An overall audit strategy is normally done through, we do it in our office through an APM, audit planning memorandum, which is a 2-pager. And then we also have very detailed audit program for manufacturing companies or service companies. So corporates, non-corporates, and so on. So that's very important. And based on that, we'll have to do the extra evaluation of internal controls if there is a smell of a failure, smell of a lapse in some of the areas which you have examined in your substantive procedures. Overall responses, audit procedures responsibility to assess the risk at assertion level. Assertions that we have to make. and responsive to the risk of management override of controls. Management override of controls, we are going to see this in detail. Overall responses to address assess risk at financial statement level. The financial statement level is the transactions have been kind of recorded properly, but it comes to presentation of financial statements. It could be an year-end inventory valuation. It could be making a short provision of an accruing liability. These are all things which are intentionally done, or overstating a liability and paying out and taking money out of the organization. Siphoning it can happen. Therefore, assign proper audit personnel. I've been teaching and discussing with members offline and online, many of the things that we say. So in audit quality, we have SQC1. We also have SA 220 on quality control for audit work. So all these standards, if you look at the key question is, do we need quality in an audit? Yes. In the very demanding regulatory, stringent supervisory environment that we are working in, you and I, we need quality in an audit. And how do we bring quality control into an audit, quality into an audit? There are three aspects, according to me. Not according to me, SQC1, the spirit of SQC1 and SA 220, if you see that, audit. Now, again, we have a huge challenge. I don't know how many of you online here are, majority of us are sole practitioners. We are 8 partners, and if you look at the statistics of the institute, there are very few firms with more than 10 partners. And Honorable Prime Minister Modi ji is talking about a Big Four coming within from India. There are firms which are capable of having that kind of teaming capabilities and deliverables. They really compete with the Big Four. Nobody is anti-Big Four, but then this is the spirit of the nation. This is the indigenous spirit that Honorable PM is trying to work out on. So we need to grow in size and develop deliverables, being sole practitioner. And I always say in this part of the country that, there's only one reason to stay single, that is bank audit, which is slowly fading out. Today, with so many multiple verticals, you have GST, you have income tax, you have corporate law, you have business advisory, you have business valuations, private equity, IPO consulting. With all this, some of us do. How can one single person manage this? So there's a need to have bigger organizations. I am not straying from the point. I'm contextually discussing this when you say audit personnel. People keep complaining that we do not have sufficient number of people. But if you have to manage assignments of that volumes and that kind of challenges have to be contained, you need to have a good team of people. So relating that to quality control for audit work, the 3 things which I said. One is a mindset to have a quality control perception, to quality control policy within the organization. The partners, the audit managers, the team, that should be part of the work culture. That should be engraved in the system of every audit as they approach an audit situation. So that's a mindset I'm talking about. 2 is compliance with standards, policies, procedures. I call them processes. So process maturity. So what is that a peer review certificate is giving us? I'm sorry. Peer review certificate is a statement that, yes, this particular firm's processes are mature enough. Required level of maturity is there in compliances. Therefore, we are giving this hallmark of professional excellence called the peer review certificate. So that is 2 is about the processes. 3 is people. You have an instructor team of people, inspired, motivated team of people. In-house training programs. Let me ask you, how many of you send students regularly for the CASA programs? CASA is Chartered Accounting students. So in South, we have CASA, you have Vicasa, all of things, Vicasa, all of them. Vicasa programs organized by the brand. How many of you have, how many of us have, I'm not blaming, I'm just asking, how many of us have internal training programs, induction programs? If a medium-sized firm is taking, let's say, an intake of, with this 2-year articleship period, it's quite essential that they are very frequently instructed, taken, given the confidence, a pat on the back most of the time, and a knock on the head also when they deviate or err or relax too much. And we also need to have a relaxed work culture where the talent can blossom, and 2 years they blossom forth as good quality chartered accountant. I always say that this is a mission on every practicing firm of accountants, that it is not getting clients, billing in crores of rupees, students as workers. It's not the case. We also have a mission of in the old Gurukul system, like the old Gurukul system. We also have a mission of mentoring them, supporting them, and making sure that they pass out and blossom forth, take wings and fly high, and probably share a dice with us on a platform like this in the future. That's also a mission on every one of us in the profession. So students are very close to my heart. I was regional chairman of the SICASA, Southern India Chartered Account Students Association also. We got the Best Region Award and all that. That's quite incidental. So to have good quality person without having a team, how do you ensure quality in a larger audit? How much is that a single person can do, or some of the old staff members can do? With the newer tools, newer technology approaches, CADs, audit software, a new team is quite essential. That's why they call it essentials. Good. Evaluate selection and application of accounting policies. Day before yesterday, there was an issue. There was a goodwill of American companies subsidiaries here. Sorry, an associate is here, and there was an issue where they had acquired goodwill, paying for. So there was they wanted that to be written off in the year of acquisition. 1 year had elapsed. The new team came and finally they said this has to be written off. I said that's not an acceptable policy in here. If you feel that you have to align with the American policies, I would strongly recommend that you align with the regulations and laws here, and then prepare a reconciliation, give it to the American ownership. That's how we put it. So very important that accounting policies are selected properly. And I hope all of you know that there are 3 considerations in selection of accounting policies: materiality, substance over form, and consistency. They have to be followed consistently. And materiality is something that's very important. We don't break our head on things which are trivial, which are not significant or material enough. And finally, substance over form. We have a legal form where it's a bank balance sheet or a company balance sheet, Schedule 3. So I'm sorry, Schedule 2, Schedule 3, 3 divisions. Division 1 for accounting standard companies, Division 2 for Ind AS companies, Division 3 for NBFCs. But then that format is technical, yes, that has to be complied with in the manner which it's required. But then what's more important, substantially more important, is the substance over form, the contents that go into the financial statements. And finally, that is what makes it true and fair and reliable. Incorporate unpredictability in selection, nature of timing and extent of audit procedures. To an extent, yes. But then here, whenever there is an issue, you would substantially expand the substantive procedures and then collect sufficient evidence either to confirm or dispel a doubt that you have. Design and perform further audit procedures responsive to assess risk at the assertion level. This is what we said. Assertion level is that at every level, we want to say that before going into the financial statements preparations, assertion is that these transactions are related to the business of the entity, for example. The valuations of the assets which are maintainable, it's in compliance with accounting standards or gaps, as we say. So the auditor should collect evidence and then if change the nature, timing and extent, that's very important. We may have to go for, let's say, hypothetically a 10% sample or a 20% sample because there is an internal audit. Internal controls initially were thought to be all right, thought to be robust and strong. But through the course of the audit, as you went through the audit, you have a feeling that information or that feeling that you had, the comfort you had got diluted or lost. Then naturally you would go for more substantive procedures to ensure that the fraud risk at the assertion level is mitigated. Management override controls is, all of us would know that, management at times, the top management themselves are issued in irregularities. We have seen in many of the cases where right from Satyam to Sahara. Satyam was a company which was given the award for best ethical practices by none other than late APJ Abdul Kalam. But what happened and how it turned around and how one of our very, very respected members of profession played a key role in T.N. Manoharan, past president of our institute, played a key role in bringing Satyam back on track. And that's all an inspiring story. So this management override is a very, very challenging. There's a significant audit risk and risk is present in all the entities. So the auditor should essentially test the appropriateness of doubtful entries. And if there is resistance to give information, some confirmation, so that will not be available. They would shake their head and say, so that is not possible, that's not available. And we need to come. Another thing is the time frame. An artificial rush is created, artificial hurry is created into the completion of the audit. My experience, my request, my suggestion to every one of you, irrespective of your seniority and stature, is that take the hurry out of the auditing. Absolutely no need for having, none of these timelines are binding on us. Bank audit is a typical example, but here we are more discussing this in the context of a corporate statutory audit. There also, the timelines is the board meeting is fixed, but then the audit readiness has to be there, relevant information has to be there. All those things which they have to provide has to be ready, with depreciation has to be calculated. Aging. Today, the aging has become so complex. Schedule 2 for larger companies, is for smaller companies, it's painful to identify. But we have today technology helping us in sorting out aging of trade payables, aging of trade receivables, aging of capital work in progress, aging of intangibles under development, expected date of completion, so much so that it becomes so very, and financial ratios in the revised schedule 3. Accounting estimates for biases. Accounting estimate is something where a lot of playing around can really happen. It could be in terms of useful life of an asset or the life of the utility of an intangible. So many things where estimates are involved. Accounting estimates are involved in provision for end of service benefits. So the accounting estimates should be free of bias. It should be maintainable. It should be defensible as well. So that is something which the auditor should put extra thrust on. Evaluate business rationale for unusual transaction. The business sometimes for expediency's sake, sometimes for surviving from a difficult situation. Like we have seen the epidemic we all experienced, and so we are fortunate to be survivors. And while we lost many of our friends, and also many of the businesses went down, those who had the resilience, those who had the inner strengths, capabilities to say that this will also pass, this shall also pass, this too shall pass, and they reduce the staff strength, they reduce the line of the business volumes, but still remained to pull on as a going concern. But then those times where there could be a lot of decisions which may not be very, very palatable from pure audit perspective, but we have always given the benefit of doubt for them to give that, of course, with sufficient disclosures in the financial statements and if need be in the auditor's report. But those are all exceptional situations. But here is a case we're talking about. Very unusual transactions are happening when everything is going normal, where unusual transactions, then the rationale should be got explained and got in writing in the written representations by the management. Any other audit procedure if required. The auditor, there is no limit to the procedures that you can adopt. Resorting to the help of external agencies, legal counsel, connecting with the clients of the company, of course, dealing with with the consent of the client. That all can be approached to make sure that risk is mitigated. Evaluate if risk of material misstatement at assertion level remains appropriate. Very important. Overall financial statement. So assertions have the risk at the assertion levels have to be the risk possibility have been contained and saying that evaluated the risk and say that there are no major risks. Then you look at the final financial statements perspective, the macro perspective of the financial statements and analytical procedures there. Analytical procedures where you do all this, rounding and saying that, okay, there's a mismatch in the overall tests. And that is where we have to do. And finally, if a misstatement is identified, then the key question is it a fraud or is it by an oversight, an inadvertent oversight, which is in the form of an error? Consider the implication of audit procedures. If unable to conclude whether the misstatement is there, consider the implications of an audit. That situation is where the doubts still linger on. The clouds of suspicion still are there. Where the auditor should essentially whether the audit can be concluded and the impact on the audit has to be evaluated in that spirit. Here is a situation which we had discussed in the first few slides. The auditor encounters exceptional circumstances bringing into question his ability to continue audit. He shall determine professional and legal responsibilities and reporting to appointing authority, that's the shareholders, and the regulator. We had seen this about 4 years back. 4 years back, there's a series of audit resignations, particularly from the bad companies which have not been performing well. Some of the business groups where the multinational firms resigned one after the other, and that is where finally it is a situation where you cannot do justice to your conscience and issue an appropriate opinion. An appropriate opinion in all these situations would have been an adverse opinion, if not a qualified opinion with multiple qualifications. That is where the auditor finds it difficult and saying that, okay, I'm not getting the required comfort or evidence, then he would discontinue from the assignment. Yes. Appointing authority, he will have to communicate naturally, yes. And the regulator also. Regulator is it's in the listed space, it's SEBI and the MCA and all that. You should consider whether the withdrawal is appropriate. Just for a silly, flimsy reasons, he should not withdraw. So, and if finally the auditor withdraws, he should discuss the reasons with management and those charged with governance, and also determine the legal professional requirement report to the appointing authority and regulator. This is where I said about the NOCLAR, which is there in the new ethical code of conduct of the new code of conduct, which is applicable now for 2 years, more than 2 years now. Now, having said all this, we did discuss, emphasize upon the need for obtaining written representations or MRL, management representation letter, from the management and those charged with governance where applicable. They acknowledge their responsibility for design, implementation, and maintenance of internal controls and systems, I would add on, to prevent and detect fraud. Prevention is most desirable, and the cliche saying is prevention is better than cure. They have disclosed results of management fraud risk assessment. Management fraud risk assessment, because management should periodically, frequently assess their responsibilities, particularly in the tech-connected environment where external access is quite possible, breaking the firewalls of your security systems in terms of information, in terms of documents, in terms of materials, in terms of influencing people, it can happen. Therefore, the management should continuously do that and disclose to the auditor the results of management's fraud risk assessment. They have disclosed their knowledge of fraud and suspected fraud. If they come across something, it's very, very important that they discuss that with the auditor. 143.12, I'm reminding you also of 143.12, where there's a separate fraud risk reporting responsibility under the Companies Act. That can be related, say 240 should be related to that also. And where the fraud, the amount involved is more than 1 crore, the auditor is required to separately report to the central government. They have disclosed their knowledge of any allegations of fraud or suspected fraud affecting the entity's financial statements. No, there is only a smell of a fraud, rather, in layman's terms. The suspicion of a fraud, allegations of a fraud, suspicion, suspected fraud. The management says that is only a suspicion. But the auditor, using his sharper tools of domain and knowledge, inquisitiveness, and experience, can do deeper drills and probably detect a fraud which is just a suspected fraud into an actual fraud which is created in defalcation or misappropriation of funds or wrong financial reporting and so on. The auditor should communicate to the management about fraud identified and information indicating fraud on a very, very timely basis, and also to those charged with governance. That is going one step further about management frauds by employees having significant role in internal control, frauds by others where they result in material misstatements in financial statements. This we already discussed, so it doesn't require a very, very detailed explanation. And finally, if auditor identifies and suspects a fraud, he shall determine Again, based on the magnitude intensity, as the spirit of NOCLAR can be, the rationale of NOCLAR can be brought into here. And communications to regulatory and enforcement authorities, duty to report, legal regulatory responsibilities normally override client confidentiality requirements. Normally, there is an implied oath of confidentiality that this kind of information that comes across audit, there is certain divinity sanctity to it, which is not to be given to regulator or people who are not normally the appointing authority. The responsibility of the auditor, the obligations of the auditor stops with us reporting to the shareholders, the members of the company. But here is a case where one has to essentially think twice and seeing whether this is a confidentiality requirement or there's a bounden ethical legal responsibility to blow the whistle louder and report to regulatory authorities. And naturally, some situations where the auditor may have to seek legal advice to determine the appropriate course having regard to public interest. So, my dear colleagues, these are the key aspects of SA 240. The time, I think we have be completing or rounding up. We can have a Q&A session on not just 240, anything that is related or of professional interest. I'm happy to have a Q&A session. And we're awaiting, expecting a lot of relevant questions. Let me say thank you to every one of you and to the ASB for having me here, and also for Devi Patwaji for joining Mr. busy schedule. Thank you all. It is back to Vivek and his team for any of the further aspects. We're taking it forward. Thank you so much once again, Vivek and team. Can I stop sharing the screen, or should I? Can I stop sharing the screen?
You can. Yes, sir. You can stop, sir. Thank you, sir, for such a wonderful and engaging session, sir. Sir, it was truly insightful and interactive session, sir. And sir, I'm very pleased to share that over 2,000 participants joined us today, sir.
2,000.
Sir, yes, sir, more than 2,000, sir. Sir,
Oh, good. Okay,
I also thank you. I also thank you to all the participants for your active participation and involvement. During the session, sir, we have received a large number of questions that reflect the key interest in the topic, sir. Sir, we will now take.
Are you putting it in the chat box?
Yes, sir, I will put these questions in chat box, and I will also I also take some questions, sir. Sir, the first question that we have received, sir, that while auditing a small business, we find several transactions with a related party that are not disclosed.
Or can you share it in the chat box? You can
yes,
share
sir,
the
I'm
screen.
Reading yeah, sir, I'm.
The tech team, please support and please share it on the screen. There's a way you can do it in a Zoom platform, no? If you
Yes,
read
sir,
out yeah.
Sir, I
While
put down
auditing a small business, you find several transactions with the related party that I'm not getting it full. Okay. While auditing you find several transactions with the related party that are not disclosed. What audit procedures would you apply to evaluate a potential fraud? Yes. This is again not just in a small business. Every businesses today have some related party transactions. Related party transactions across the globe by regulators are seen with disfavor. We have section 188 of the Companies Act dealing with related party transactions. Talk about 189, a register to be maintained. If you look at the Income Tax Act, we have 48(2)(b), where the assessing officer is empowered to disallow unreasonable transactions with related parties or disregard. AS 18, Accounting Standard 18, deals with complete disclosure of related party transaction. And the separate standard, since we are on SAS, SA 550 is the standard which talks about how to identify related party transactions, make the management disclose all the related party transactions, and that gives a complete guideline on what are the audit procedures to be applied in evaluating not potential fraud, in evaluating related party transactions. And in related party transactions, you have to compare that. The key question in all these transactions is whether they are arm's length, whether they are maintainable. what or have you done an undue favor to a related party? For example, you are a listed company and there's a private limited company in which one of the directors or spouse is interested. Then these transactions have to be viewed with suspicion. And if it is in the normal balance of transactions, there could be a quality issue. There is a matter of convenience. Then yes, that can be passed. Otherwise, if the transactions are irregular, like for example, you are giving undue advantage to those entities, then that by comparing with the similar transactions within the entity, industry practices, you have to identify there are potential frauds. And that is where they say that, then one step at some point of time, the auditor should become an investigator, should become a CBI, at times even go for a forensic audit. But not in the strict sense of it. The audit approach would take the characteristics of an investigation or a forensic audit.
Okay. So the next question is, what are the precautions to be taken by auditor while auditing if the top level management is involved in the act of fraud?
That we did discuss in one of the slides in between. That is the management. That is the layman's terms. It said that the fence itself eating the crop. The top management are the people who are interested with not in a small private limited company. Let us elevate our thinking to that of a large listed company, where you and I are shareholders. Across the globe, there are shareholders from US to Finland. And the management is entrusted to a handful of people called board of directors. And there's a managing director, there are subcommittees, where from an audit angle, the entire transactions have to be evaluated, not disregarding the possibility of management override of controls. They themselves holding in a procurement from one single party, refusing the CFO or the team to have set access or full details of a transaction, and discussions with them, continuous discussions with the management themselves. And of course, the nature of transactions, we said unusual. In fact, if you look at the standard, it talks about unusual journal entries which are of not a regular nature. And those are things which the auditor should look into in depth, go in depth, percolate down in depth, and try to make sure that there are no irregularities, no frauds by the top management themselves, the board minutes and independent interaction with independent directors and so on. But still, with all this, it is possible that experience tells us that with all this, there could be very deeply laid frauds which goes undetected, which is to an extent accepted. That is how I started the session with the reasonable assurance and not the total absence of irregularities, particularly by the management circumventing the controls of the organization, or management override of controls and systems. That's the terminology used.
Okay. So the next question is, to what extent is the auditor responsible for fraud in audited financial statement if no fraud is detected during the audit, or if a fraud is
I think this
missed?
participant joined a little late. In the opening remarks of the session, I did mention that no, the answer is no. The auditor cannot be held responsible. But the key question is, did the auditor did auditor follow the auditing practices, collect sufficient information? For example, confirmations from related parties, confirmation from receivables, confirmation for payables, bank balances, uh, contingent liabilities, and so on. So what you said is this term I forgot to use. Yes, the auditor has got a lot of inherent limitations because as estimates are involved, we rely on a lot of information which are persuasive, not conclusive. That's a technical term. Most of them are only persuasive in nature, persuades us to believe that they are all right, but they are not essentially conclusive. If it's a forgery, for example, auditor may fail to detect, but he cannot be taken taken to task for an undetected fraud, which is so ingenuously laid down, which is so deep, and an audit procedure could not detect. No, we cannot be.
Okay. So the next question is, if long outstanding receivables are knowingly retained in the books of account to avoid affecting profitability, can the resulting material misstatement can be considered as a fraud?
Strictly speaking, no. This is information on the table. This information on the table now. Today, for example, in a corporate reporting regime, we have receivables aging, which is unbilled 1 to 3 months, some is at 3 to 6 months, and then more than 3 years is outstanding. So in any audit, if there are outstandings which are more than 3 years, they're non-moving. Of course, may not be acknowledged. AOD is also not there. If AOD is not there, law of limitation would apply. This has to be a write-off has to be instructed or provision has to be instructed. But this essentially does not mean a fraud. But the original transaction, if that is remaining there, the original transaction could be a fake transaction, or somebody would have benefited and they are refusing to pay, and that possibility has to be ruled out. Because it is long outstanding and it is not getting paid at this point of time, it is not essentially fraud. But whole transaction, right from the inception of the transaction, if you see, there could be some irregularity which is in the nature of a fraud. That is how I would look at it.
Okay, sir. So the next question is that management refused to provide certain documents requested during the audit and claims they are confidential. How does this impact our assessment of fraud, risk, and audit opinion?
Yeah, this essentially puts a limitation on the scope of the audit. That's a term which we use. Like our friend earlier said, the inherent limitations of the audit. This is essentially a limitation on the scope of the audit. And in the first line of the auditor's report, we are saying that we have obtained all the information and explanations necessary for the purpose of the audit. So here, for what is the confidentiality you're talking about, the auditor, very rare situations where any information for that matter is sensitive. That way, we have to instruct our students and team also to maintain that confidentiality. In everything that we do, there's an implied oath of confidentiality. The management should have the confidence to share it with the auditor. It's a very fiduciary relationship, and the management should have the confidence. And with all that, if they are refusing to give information, which is crucial for the purpose of the audit, crucial for your forming an opinion on the financial statements, yes, it's a limitation on the scope of the audit. I think ultimately this would go into a disclaimer. The disclaimer would probably take care of if it is arising from fraud also, that will be taken care of.
Okay. So the next question is that in one case where I am an auditor and one of director has committed fraud, amounting involved is around 2.5 crore, which was revealed by another two director. What is our responsibility for the same?
This is a clear case of fraud that we have seen, because Marcel situation becomes difficult when everyone is involved in the fraud. If all the three directors were involved in the fraud, this would not have come up. But there is one director has taken undue advantage or taken some money out by fraudulent methods to his own entity, or taken out money for his own individual benefit, self-interest. Then the other directors have reported. So 143.12 is triggered if it's a company. Small company or not really doesn't matter. But 2.45 crores in a small company is a very material amount. And this is a fraud. This has to be reported, essentially reported. And the auditor will have to qualify the report saying that 143.12, as well as the impact of that, because 2.5 crores has gone out of the system. So true and fair may be vitiated. It has to be reported, no doubt about it.
Okay.
You are lucky to have the other two directors reporting the fraud to you, because you have it from two of the horses' mouth, and one is the one who is the culprit.
The one question is, a company is holding a motor car from whom substantial amount is receivable. What is the duty of auditor in this area? Company is holding
Company is holding, in the sense that company is holding back a car.
Yes, sir.
They have to go for the legal proceedings. If the amount is substantial, motor car, I don't know what kind of a car it is and what's the size of the company. I don't think it's a major issue. The company is, if there is an agreement, and I don't know how the car came to the company's possession from a normal receivable, from a normal debtor customer, how it came to the possession. So that is something which they have to legally deal with. And I don't think this will require a remark unless the amount is substantially huge. No, it is not a major audit constraint. But then, if it is by agreement that it is held back, if in other words, if it's a hypothecation, NBFC holding back an asset which is a hypothecated vehicle, then it is perfectly legal. There's nothing much to be reported. The legal proceedings have to happen. Finally, either a loss or a surplus, if it is there, it's paid back. A loss, if it's there, it has to be booked at that point of time. So I presume that it is a hire purchase or a leasing company. where this is quite, they call it seize the security, seize the vehicle. The team of people, the others to do that and all that in some places. So that is okay. Then we'll have to, unless you expect a huge deficit by realizing if the receivable is, let's say, 1 crore and you only have, let's say, Maruti 800 with you, then there is a lack of security. Those provisions and all those things will have to be made. Can AI identify fraud? How to evaluate the legal cases given by AI is relevant. Yes, that is what I'm not a tech person. Yesterday, I had a discussion with my partners on having more of technology and use of audit software in this. Yes, AI's methods, many of the methods are very, very effective, I have heard, but I don't have a very clear, effective answer to this question. But yes, we have to start applying more of technology into all that we do. That's what I would say.
And sir, this is the last question that what are the legal and professional safeguards available to auditors who report fraud? And what extent of their responsibility in reporting fraud, sir?
That's a very, very difficult question, but it's a very, very relevant question. The risks are of various types. The first risk is that, okay, this is reported. So you are not allowed to continue as the auditor. But here is a situation where under the Companies Act 2013, the auditor is appointed for a period of 5 years. So during the period of 5 years, the auditor cannot be removed. So he can still cling on. But you and I may not, because the relationship has been strained and therefore you may move out of the assignment. But then by not reporting, if there is an irregularity detected, the consequences could be worse. So you would probably at that point of time resign from the audit. But I think there is an extra meaning to the question. Safeguards available to auditors who report fraud. To an extent, if you are in an environment where there are other threats, then it's only the legal recourse. Or else we belong to that category of silent observers and saying that not reporting the fraud. As of now, the courts of law, the regulatory authorities should give us the required protection. But see, the chance of losing the audit, yes, or losing the audit, if it's a which has to be reported, I would strongly recommend, and I would have done that and quit from the audit after expressing the opinion. You can, or like what we have seen, when you resign itself without expressing an opinion and by reporting that to those charged with governance and sometimes even beyond to the regulatory authority, your job is done. Otherwise, it is a normal, the legal framework that we have in our country, which would protect, which we hope and pray, which doesn't happen all the time, hope and protect all the citizens who have done their justice to the cause of good governance and legal compliances.
Thank you, sir. Thank you. We have covered all the questions, sir.
Good.
And thank you once again, sir,
Very,
for
very
such a
relevant
nice.
questions. I don't know whether the audience are able to hear me, but the very relevant questions makes me believe that you were glued to the presentation and all the questions were relevant, though we do not have very conclusive answers for some of the questions we have answered. Great time
Yes.
with the members from across the country, maybe abroad as well, and happy to associate with them. It was always a pleasure. As a former member, I take pride in being part of this. Thank you once again to Sri Priya Kumar of Chennai, who is the chairperson of ASB, and of course Ravi Patwa for the vice chairman, and all of you, Vivek, all of you doing a good team.
Yes, sir.
Tech support, there were no glitch, so good tech support. Thank you very much. Keep going.
Thank you,
All
sir.
the very
Thank you
best to all
for.
of you. Thank you. Bye bye.
Thank you, sir. Thank you.